right, 8 o'clock on the dot. Want to make sure we respect people's time. Hey, I'm just glad you all are here. Absolutely, this is fun. So this has been an experiment for me first and foremost. I'm going to share with you the reason I want you all to be on this, but I want to give this a shot. The Google Hangouts. I thought about paying for this thing called Zoom, but it's like $600 or something like that. And I was like, I don't know. And someone that I'm pretty, who was that? I think it was Jessica Stansberry, actually, who I interviewed for my podcast. She says you can do all this stuff for free with Google Hangouts to do like a kind of like a webinar thing. And because I'm going to be doing a lot more of these going forward because I actually enjoy them quite a bit. And I think they're pretty efficient. So anyway, so this is kind of experiment, as you can see, is somewhat clunky, but we'll get it down. It's fine. But I appreciate I pour brass in Colonial Williamsburg and need to invest correctly. Right on. Right on. Okay. That's Sunshine Susie from Williamsburg, VA. So that's cool. For Virginia right now, and the western side is apparently they're going to get hammered with old Florence. So think about those guys. Some guy posted, well, never mind. I'll just forget that. Anyway, some guy was kind of negative, like no one cares about hurricanes. I was like, man, it must be nice not to have any people who are affected by that stuff. That all you care about is yourself, but whatever. All right, so I do want to do some stuff here with the Vanguard chart. I want to share with you. If you've been watching my videos at all, you've seen this chart before, but so important to understand the Vanguard. It's probably the most important chart you'll ever see, frankly, in my opinion. Especially like Sunshine Susie said about investing. Someone else up here said about investing too. And we're going to talk right about that. So I appreciate you bearing with me my clunkiness here. That's for sure. So let's get right into it. I'm going to go to screen share, and I hope this works. Jeez. Woo. Let's see here. All right. So we're going to give this a shot. I think I got to go to there. Let's see if I screwed up. Bear with me. And I did. All right. So let's go back. We want to go to here. Oh, that's not what I wanted. Hold on just a second. I got to go over here. Bear with me just a second, my friend. Screen sharing. We're going to go to application window. I got to find my Vanguard one. Hold on right there. Vanguard. That's not it. That's not it. We want to go to that's all right. Hold on just a second. I'm going to find this guy. Let's see. Hold on just a second. We're going to find it. No, that's not what I want either. All right. Hold on. Stop. My screen share. Where the hell is that thing? All right, entire screen, application window, Social Security. Is that what I want? That's not what I want. Okay, hold on just a second. We're going to find this thing. I got too many friggin' tabs open. All right. Application window. It's this guy right here. That's what I want. There we go. Okay, cool. All right, so we want to go to don't want that. We want to go to right here. All right, so I'm hoping you all can see this PDF. So I'm going to come out for just a second. Can you all see this PDF from Vanguard? When will we get back to average returns? I'm going to come back for just a second to this right there. Oops. This right here. Where am I going here? All right, so I want to bear with me just a second, guys. Okay, sweet. All right, good. See, I got to figure this out. I'll get it next time. Okay, so you can see it. Fantastic. All right, let me get back. All right, so this is the most important there. All right. I think we got it. We're going to hit this guy here. All right, sweet. This right here is from Vanguard. Vanguard does tons of great studies, my friends, on just investment planning. Obviously, that's what their bread and butter is. They do tons of great studies on healthcare and retirement. They just put a good thing out a few weeks back, which I've already done a video on, but I'll probably do it again. And then they just do great stuff. Vanguard, I'm a big fan of them. Let me just make this a little bit bigger. All right, so this right here, and again, this might be boring to some of y'all because I've talked about it a couple of times. I have 350 videos out there, and I've talked about it a few times, but I just think it's critical. U.S. stock market from 1926 to 2017 as represented by large cap stocks, essentially the S&P 500. And this right here, my friends, that is the modern era from 1926 on. If you look at Bob Shiller's stuff from Yale and then what's his name, Siegel's stuff from Wharton, they'll go back to like 1850s, 1860s. It's just not enough data to really use that for any kind of consistency to say, hey, what can we extrapolate from previous returns going forward? So 1926 is kind of the modern era. And what I like about this is say annualized returns 10.27%. All right. So here's your annualized return right here, 10.27%. But look at this. Let me just read this to you. Average returns to stock and bond markets are often cited in financial circles, perhaps giving lay investors the false impression that these returns are the norm. So we think this is the norm right here, the 10.27, because that's what the annualized returns have been going back to 1926. That's 90 years of history. In reality, there have been few years when either stocks or bonds delivered returns that are even close to market averages. Financial markets, particularly stocks, are inherently volatile over the short term. To benefit from long-term market performance, investors should temper their expectations and stay the course. And so I want to show you something right there. Returns fell within 2 percentage points of the average only 6 out of 92 years. So, I mean, the average is 10.27. They're at 8.27 to 12.27, only 6 out of 92. And I take my trusty calculator and I divide 6 by 92. That means only 6.5% of the time do the returns not only not give us 10.27, but only between 8 essentially and 12. I mean, that's amazing. So you got huge ups with huge downs, huge ups, here's 40%. Look at that. I mean, that's 40% ups. You got 30% across the board ups. You got 40% down. This is 2001 and 2. I mean, this is not -9, -11, -22, 1973 and 1974, 75, 76, 77. So, I mean, this is 81. And then you got 82, 83, 45. You got 94, I think that was. Or was that 1990? I can't remember off the top of my head. But anyway, I mean, look at this. So the point is, anyone who invests thinking they're going to get this on average, this is over 90 years, and you just didn't get that on average, and you just didn't. That's why I always recommend to people to realize for your returns, you can't expect this rate of return. And if we go to bonds, it's the same thing. Now, it's not nearly as volatile. Range fell within 2 percentage points of the averaged bond of 5.35, basically 30% of the time. So here's the average bond right there, 5.35. All right. And the range of bonds was between 3.35 and 7.35, only 30% of the time. The other times they had huge divergences. I mean, it's not even with spitting distance. And so and I just want to talk about stocks in particular, because stocks, you can see the volatility there. All right. So anyone who says I'm going to invest and I expect to get 10.27, well, hell, not. I mean, when are you going to get 10.27? This year, that year, this year, that year? Let me just go back here. I'm going to go back to my, there we go. So I'm going to stop this. See if I can't bring up the, hold on just a second. See if I can't. Okay, there we go. Sweet. All right. Hey, Mark. All right. So the point about this is that if you're investing thinking you're going to get an average rate of return of 10.26, the average rate of returns are literally the average over, in this case, almost 100 years. If you're investing for 5 years, if you're investing for 7 years, you just simply cannot use those average returns. You can't. And I cannot tell you how frustrating it is to see people from financial advisors recommending, oh, this did that, that did this. You should be able to get this. You should be able to get that. Hell, you should. We have no clue what you're going to get, which is why I say you have to review that every single year, because if the markets are up 30% in 1 year, and they're, maybe it's time to take some gains off the table. Maybe it's time to say, something, let me reposition stuff. Maybe it's time to say something. I don't know what it'd be. Maybe I can retire now. I don't know. But you have to have that plan for each year. The planning is for each year. It's not from now. I'm 48 years old. I'm going to plan until I'm 67 for my full retirement age. You can't sit there and say, I think I'm going to get 10% a year. That only is a factor if you're not going to touch the money. If you don't touch the money, that's fine. Be my guest. But if you're going to touch the money within 5 years, that 10% is completely irrelevant. It's fake. We don't know. It might be 20. It might be 2. We have no idea. But you can't bank on that 10% for any kind of investment term that's not long term. And so I'm just telling you, at the end of this is why I'm so big on paying down debt, because the one way we can guarantee a successful investment rate of return is to pay down debt. Now, I will say a couple of things. This is why I follow the model, the tried and true model. You keep enough for cash for a couple years, and then you put the rest in stocks. And so if you think about it, and I'll beat this until I'm dead on YouTube or YouTube fires me. But you say at the end of the day, for the next 3 years, I need 50,000 a year. Let's just say I need 50,000 a year, or I say I need 100,000 a year, whatever. I got 50,000 a year from a pension. All right, so I need 50,000 a year. You see, it doesn't matter. I need 60,000 a year. I got 20,000 from a year from a pension. So I have 40,000 I need to have 40,000. We'll just use that for simplicity. I need 60,000 a year to live on. I got 20,000 coming from a pension. That means I got a 40,000 gap I got to make up. That's what I got to do. So with my pension locked and loaded over here, I still got to come up with 40,000 a year. So what I'm going to do is I'm going to take $120,000. I'm going to park it in cash, or a 1 year CD, a 2 year CD, a 3 year CD. Franco, actually, it wouldn't be a 1 or 2. It'd be a cash for the first year, a 1 year CD for the second year, and a 2 year CD for the third. And what happens is, let's just for simplicity, I put $250,000 in the markets. I got that $60,000 that when I needed $120,000 in cash. Yeah, 120, because I need 40,000 a year. So I got 60,000 is what my need is. 20,000 comes from my pension. I need 40,000 a year. 40 times 3 is 120,000. I know it's incredibly simple, crazy, right? So I take my 120,000. I'm going to take that from the cash account, that 40,000 I need for the first year. I revisit. I come and see what the markets have done. If that 250,000, let's say the 250,000 has grown 8% times 1.08. So now I've made $20,000. So that 280,000 has grown by 8%. Then you say, should I take that $20,000 gain off the table and replenish some of the 40,000 I just spent for living expenses? And that's a pretty good portfolio, because what you're doing is you're saying, at the end of the day, I'm going to take the gains when I have them to replenish the cash that I've spent. And if those gains don't matriculate, that's fine, because I have all this cash over here. I don't need to sell stuff at a loss, because that is the critical thing. If you can avoid selling stuff at a loss, you're just going to be happy. You're going to be just so much of a better place. The issue is, I need that 10% a year, 6% a year return to the market, whatever it is. You can't sell stuff at a loss. If you do that, you're going to lose your hair, because you'll sit there thinking, the market's going down, I'm pulling money out of it. And everybody and their mom will say, yeah, but look, man, the market's average 10% a year. And you're like, hell's bells. The market averages 10% a year for people who aren't touching the money. If you're touching the money, it doesn't average 10% a year, because you're pulling out. Well, the market's going down. You can't have that. You got to let the market go work its magic for the power of compounding interest, like what's his name, Einstein says. And if you can just avoid touching your market investments, when the markets are going down, you're going to be just fine. And so again, you take your $40,000, you spend it. Your CD matured, because you got a 1 year CD. That sucker matures. You take that money, you spend it. And in the interim, you're looking, did my 250,000 grow? Yes. Should I take some gains off the table to replenish some of my cash that I've already spent? You may be. I don't know. What if the 250,000 grew to 300,000? Well, I would say take 40,000 off the table. Take that out. Yeah, you don't even have to pay capital. And if it's an IRA, you're going to have to pay income on it. But you're not going to have to pay capital gains necessarily if it's a non-IRA account, because you will have a cost basis. I don't want to get too much of the tax out of this, but just remember, potentially you could have to pay tax. I get that. If it's an IRA, 401k, or something like that, you're certainly going to pay tax, because the money's got to pay. You got to pay tax on it. So you got this money up here. And you say, okay, I'm going to touch that 30,000, 20,000, 40,000 I made. I'm going to replenish that first year of cash I just spent to live on. I'm still at $250,000, and I look over on the side, I still have 3 years of savings just sitting there. It's not going to make much interest. I get it. When it comes to retirement, I don't care freaking about interest at this stage, for this stage of money. I just want this money to be there safe, that I can access, that I don't have to sell stuff when it's down. And if I have to sell stuff when it's down, I've done something wrong. That's the issue here that we have. Either I've miscalculated my expenditures, or I've spent too much. So I miscalculated. Maybe I spent 50,000 a year, not 40,000 a year. Or maybe this year I took, I don't know, my next door neighbor on a cruise to China. Whatever it would be, but I spent too much. And so now I have to dip into this pot of money called my equity market. And if you just think about it like that, and some people use a 3-bucket approach, it's where they keep bonds, and I'm fine with that. Frank, I think it's a little bit too cute by half. I just like stocks over here and bonds over, and now I just said it, bonds. Stocks over here and cash over there. That's right. So here's CB. That man, dude, it's 100% right. Historically, markets have recovered within 3 years more often than not. In fact, I absolutely 100% right. And so so anyway, let me tell you what that says, because he probably explained it better than I did. But if you can avoid taking cash from the stock market when the stock market has gone down for 3 years, historically, you have been made even again if you can avoid that. Michael says there's an advantage of CDs over treasuries. Yeah. Remember, the treasury is a security, all right? And anytime it's a security, has a price, and the price can drop. Right? And I mean, it is guaranteed. And I'm a huge, in fact, I'll just tell you right now, I love the Vanguard Ginnie Mae fund. Look, I'm not making a recommendation. Please don't say I know you, not for any of you guys. But for me, I always like the Vanguard Ginnie Mae because it's essentially a treasury bond, but it has a wonderful track record. Where it only had one down year, I think, in its existence. I think that was in 2014. Don't quote me on that, but basically it's roughly one down year since existence. And the Ginnie Mae is government bonds, not quite treasuries, but they are 100% government bonds. And see this house behind me, the Ginnie Mae is who loaned the money for the Veterans Administration for me to borrow to buy my house with a VA loan. And that's what Ginnie Mae is. They back the Veterans Administration loans and some other, I think FHA loans too. Anyway, the point is, if it's a security, it can drop in value. Now, if you look at, like the Ginnie Mae, I think it was down 3% in 2014, something like that. So we're not talking huge drops. But with treasuries, there could be huge drops. I mean, especially the longer term treasuries. If you have a long bond, a 30-year bond, and that sucker can drop pretty big if interest rates spike against you, and that's a security. So at the end of the day, I'd look at 1, 2, and 3 year CDs, and then maybe I don't know if I don't think I'd buy a security, Michael, for that short amount of time. There's too much risk of the market dropping against it, and we just want to avoid the risk. And I'm not even sure. I mean, if you think about CDs, how they work is I can't remember anyone know what a 1 year CD? I have literally no idea. 1 year CD right now is probably paying, I don't know, 1.5, I imagine. And let me just look real quick. I think the 10-year just broke 3% again yesterday. Yeah. So the 10-year is at 3. If you see the TNX, I show this all the time. That's a 10-year treasury right now. So if you have a 10-year treasury at 3, and that's literally locking up your money for 10 years, and I can get a 1 year CD, I'm just throwing a number out, 1.5. I'll take the 1 year CD any day of the week over that. T-bills, the same. I mean, T-bills don't have any volatility there, so I wouldn't have any problem with that. Absolutely. How you actually execute the sale on that, you got to go to the bank or something like that. Frankly, I can't remember, but I'm okay with that. Ally CD, 2.5. 2.5 for what? For how long is that CB? So that Ally CD at 2.5% for what's the term on that? Do we know? Because frankly, that's So Michael was saying 4-week T-bill at 2. That's pretty good. So I just don't know how you execute that. I don't know how you actually go about buying and selling a treasury bill for your cash. I'm sure it's easy. I just don't know how to do it. With that though, nice thing about CD, and I'm not deferential. I'm not saying everyone should do CDs. I just think for the ease of it, you can just keep rolling them over 1 and 2 years, 1 and 2 years, 1 and 2 years while you're pulling money off the markets when they give you a gain. I'm a huge fan of taking your gain off the table. I wish more people would do this. They all get caught up in the tax consequence. If I have an IRA and I'm taking gains off the table, that's not a taxable event unless I pull the money from the IRA. Just keep that in mind. If the IRA just sits there, the umbrella called the IRA is still over the money, it's not a taxable event. It's only a taxable event when I pull it out and maybe move it over to a CD in an individual account as opposed to an IRA. So that might be something you want to think about a little bit, because any money that comes out of your IRA or 401k will come as tax as ordinary income. And that could be problematic. I get that. But at the end of the day, you got to spend the damn money. You got to live. And so if you have this IRA money, and I had a lady comment today on the YouTube, I can't remember what she said, but she's hoping to refrain from taking Social Security until she's 66, but she was in dire straits financially. I'm like, well, screw that. Yeah, 1 year CD at 2.5 says CB. Look, Allied Bank, I think that's the bank from General Motors or something like that. I can't remember, but that's all internet. If you get a 1 year CD and you want to make sure it's FDIC insured, at 2.5 and the 10-year treasuries at 3, yeah, I would take that in a heartbeat. So I'd say, look, I get a 1-year CD at 2.5. I mean, that's pretty good. As long as it's liquid, as long as there's no penalties after the 1 year. And one thing, just real quick, on a 1-year on a CD, just make sure it's not automatically renewable. I cannot tell you how many times, yeah, right on. And banking, people would do CDs when they have automatically renewable, and then the bank, just sheepishly, if I might say, we sent you a notice that your CD is coming due. We gave you 7-day grandfather time. We never heard from you. You're like, man, you sent me an email. I got 8,000 emails on my phone. I'm sitting in the friggin' airport, in Tucson, Arizona, and I just forgot about it. Now that sucker rolled to another 5-year CD. And if I break that, I got to pay 6 months of interest as a penalty. Yeah, don't do that. So whatever you do, don't do an automatic renewal CD. I just, it's you know what else banks do? Did you know this? So banks, if you bounce a lot of checks, all right, let's just say, for instance, you forgot to bounce your checkbook one day. All right. This is such a freaking scam. All right. So what they'll do is they'll say, we're gonna clear your biggest check, and then we're gonna bounce all your smallest checks. So what that means is, say you have 5 checks that are about 5 checks. All right. You only got enough. You got 1 check's for $10, 1 check's for $30, 1 check's for $50, 1 check's for 70, and 1 check's for 800. All right, but you only have enough to cover the 800. You don't have enough to cover the other 4, or you have enough to cover the other 4, but not the 800. What they're going to do is they'll bounce the 4 and let the 800 through, because 800, that must be your most important bill. That's what they say. That's your mortgage. We don't want you to be late on your mortgage, for heaven's sake. And you're sitting there thinking, yeah, but how many friggin' bounce check fees did you get? You got $30 a pop on 4, so that way, because you're just doing me a favor by letting my mortgage go through. Yeah, that's bad. That leaves a bad taste in my mouth. And I don't know if they're still doing that, but I used to work at a local bank, and we'd call this a long time ago. We'd call you up, say, hey, just picking on you, CB, looks like one of your checks are going to bounce. We don't want to bounce it. Can you come down here and drop some money off before we bounce it? And you would say either yes or no, either way, but we'd always try to call you to get you in the branch so you could actually pay it, so we didn't have to bounce the check. Just as an FYI, if you're bouncing checks, I don't know if they still do this. I thought it's horrible business practices, but they always let the biggest check clear so they can bounce your other 4 ones, because they're so worried about you not paying your mortgage. Bull crap. All right, so CB says the last December was 2%. So if you get a 1-year CD at 2 to 2%, I think you're sitting pretty good. Any idea what the 2-year is, big man? That'd be interesting. So if you have a 1-year at 2.5, a 2-year at 3, I can't imagine 2-year CD would be 3%. On top of it, while I'm yapping on CDs here, so you can actually, a good strategy on CDs is, some banks, they would allow you to break a CD and only pay 3 months of interest as a penalty. So in your head, you say, okay, I got a 3-year CD, a 5-year CD is paying me 4%. All right, so if I break it before the 5 years are up, I only lose 3 months of interest. And so what that means is, just for simplicity, if I have $50,000 in a CD that's paying me 3% interest, that's going to pay me $1,500 over the course of that year in interest. Now, let's just say down the street there's a better CD out there, and I can say, okay, so I will lose 3 months of that $1,500 of interest. I will lose, in that case, $375 of cash in order to go down the street and buy a higher rated CD. Is it worth it? Well, if I can get more than that $375 of cash of a fee that I lost on breaking that long-term CD, the answer is yes. So for instance, now I will say I can go down that bank, and Ally Bank has got a 5% CD on $50,000. So now 5% on $50,000 is $2,500. I mean, so now I'm making $2,500. I've lost $375 of interest to get that $2,500, but even net of the losing fees that I lost because I had to sacrifice 3 months of interest, I'm still hundreds of dollars ahead. So that's a pretty good strategy, and that might be confusing. But basically what you do is say, okay, I'm going to lock in for a 5-year CD at the highest possible rate. If it's 3 months of interest that I will be penalized to break the CD, I can actually weigh that. I can say, is this new CD that I can get down the street at a higher rate worth my $375 of fees to break this one CD? And simple math, you just say, okay, if I can get $500 more of interest, that more than compensates for the $375 I've lost to break the certificate of deposit before the maturity. I hope that makes sense. It's an old banking trick from back in the days. It was actually a really good strategy, especially when interest rates are a lot more volatile than they are now. So just in the back of your mind, don't overlook in banks, guys. I think banks, CDs in particular, get overlooked a lot in financial planning. And the reason is because they're boring. They're not very exciting. They just sit there completely free of any volatility. There's no algorithms or anything like that. There's no professional money managers. No investment guy sells them because they don't get paid on selling them. So no one talks about them. But incorporating CDs into your retirement plan is wonderful because, like I just said to start this thing off, Vanguard says you get 10% a year, but you don't get 10% a year. You get this. You get 10% a year if you hold the money for thousands of years, essentially. Maybe. We don't know if that will, again, emerge, but you just ally.com. Yeah. Oh, there you go. So Michael's saying 1 year T-bill yields 2.55 online at Treasury Direct. Aren't there limits on how much you can buy though? Or is that, no, that might be I-bonds. I forgot. So there's something else. Treasury Direct, is it treasurydirect.com, I guess? You can actually buy T-bills without going through a broker. You just do it on your own. That's pretty cool, man. So anyway, so there we go. We got CB telling us about 2.5 1 year CD at Allied Bank. My man Michael is saying a 1 year T-bill is 2.5 roughly for 1 year with no fees, and that's 100% guaranteed. Yeah, or treasurydirect.com. I don't know how that works. I've never done that, so I'll put it up to your devices, folks. But man, that's if I can get 2.5 with guaranteed money, either through a CD or through a Treasury bill. So remember, Treasury bills are literally the safest investment there is. That's the riskiest, the risk-free investment there is. There's no less risky investment than a T-bill, because a T-bill matures like every couple of weeks. I mean, it's literally, I think a T-bill goes up to like 1 year, then it goes to T-notes or some terminology and all this stuff escapes me from now. It's been so long. But and what a T-bill is, you got T-bill and you got T-notes and T-bonds. Is that right, Michael? T-bills 1 year or less, I think, is how we say it for a Treasury bill. And then a Treasury note, I think, is like 2 to 5 years. And the Treasury bond is kind of anything above that. That's just semantics or terminology. But if you can get a T-bill and you just go to treasurydirect.com, dump in $25,000 that you're going to need for 1 year out. All right. I'm going to need that money a year from now. I don't need it between now and the next year, but in the next year after that, I will. It's not a bad move, man. Not a bad move at all. Now you take your $250,000, you revisit it at the end of the year. It's up or it's down. One of those two things. If it's up, I think taking gains off the table is a wonderful strategy. You say, I don't care if it's $13,000, just take the gains off the table. Lock the gains in, because once you lock them in retirement planning, they're yours. Now you're not going to compound your interest that way, but that's it. So Michael was saying a T-bill is less than 1 year. All right. So that means there's basically, again, you can't get any more risk-free than a T-bill. Minimum purchase, $100, $100. Talking to a lady today, wonderful lady. And she's like, I read your YouTube thing on Roth. I don't know if y'all remember her. They wrote her about her in Money Magazine, how she sold all her stocks. And I had no problem with that. My only concern was the tax consequence. They didn't talk about that. And she goes, look, I'm just sick of thinking about this crap. I'm thinking I might just want to go the Roth way and just start putting money in and save stuff. And I said, I don't care. That's fine. You probably keep some to get some growth out there, but if it helps you sleep at night, who cares? I mean, especially if you don't have any big, I don't want to leave $1 million to my kids or something like that or whatever. Just be, life's too short. Dump it in some CDs. And again, you need to get some growth because inflation is out there, my friends. It is out there. So I don't want you putting all your money in T-bills or CDs like these guys are saying. But if you're freaking out and you're about to retire, screw that. Just put some in there in your cash, some in CDs. You can go as long as, like I said, a 5-year CD with a strategy that you might be able to bust it out if the rates start increasing quickly. It's not a bad move. I don't have a problem with that at all. So anyway, that's what I wanted to point out is that you got the strategy. The 10-year return or the 10% a year returns are just, they're not there. It's fleeting. Don't bank on that. What you bank on is, what do I need this year for cash? This is how much I need for cash. I'm parking over here. This is how much I need for cash for the next year and the next year. 3 years of cash. I'm parking it right there in T-bills, CDs, or even just a good old-fashioned high-yielding money market account. Frankly, do not care. But I got 3 years covered. If when I quit and hang up my boots, the market's tanked 25%, which they're certainly going to do, I don't care because I don't need to touch that money. By the time the 3 years are up, when I'm exhausted from cash, pretty good likelihood that that money that I've lost in the market that went down from 250 to 200 is back up to 250. Not all the time, not all the time, but there's a pretty good probability of that have happened. And that's the worst case scenario for the most part. Now, if this was back in 2001 and 2, it went 9, 11, and 22%. So 3 consecutive years. And that, we didn't know. And even in March in 2003, we're still down on the bottom. We had what's called the dead cat bounce. It bounced up a little bit and then bounced back down in March of 2003. And I remember that like it was yesterday. So it wasn't that easy to remember. In hindsight, it is. But during those times, we did not know we were out of the woods. We just did not. And the same thing on March 9th of 2009, which is the bottom of the Great Recession. No one knew that that was the bottom. It was scary. And so if you're sitting there retired and you're like, I just blew through all my reserve cash and now the market's the only thing. Yeah. Okay. Yeah. All right. So CB asked me to touch on sequence of returns. So now the market's over here and they're bottomed out from October 2007 to March of 2009. It's not easy. It's not easy to sit there and think we're going to be okay because historically the markets have been okay. It's not. It's tough, which is why I love having cash. So CB asked me to touch about sequence of return risk. Man, I'll have to do a video on this by itself because there are a lot of nice charts on that. Sequence of return risks. In fact, there was one American funds did. I can't remember the dates. If you retired in 1975 because you missed the 1973 and 1974 chaos, if you retired like 250,000 in 1973 and you retired with 250,000 in 1975, it's something like that. There's 2 years difference. One went bankrupt like within 18 years, and one had $8,000 million because a guy who retired. And when I say guys, it's all gender. I'm from Maine. We say guys. That's what we say. In the South, they say hey y'all. In the Maine, we say hey guys. So just don't be offended. It's way too much to be offended by nowadays. So not that. Anyway, so at the end of the day, what happens? The guy or the lady who retired in 1973 pulling 5% a year off her portfolio. So she had $250,000. Pulling 5% a year off, that's $12,500. And she's thinking I'm good to go because the markets have averaged 10% a year. But she wasn't good to go because she retired right into the decline of 73 and 74. And she never recouped, even though she's only pulling 5% a year off. And so 18 years, I'm almost positive 18 years, she had nothing, literally nothing left. The same guy retired in 1975, let's say the brother retires in 1975 doing the same damn thing. And 18 years later, he had, millions left over because he retired almost at the beginning of the Reagan boom of 1982, going into Clinton years as well. So from 1975 until 1999, the markets were on a freaking tear like you couldn't believe. So that guy had like 2 or 3 million left over. And the other guy had, you're right on another video. Yeah, I'll show you the thing from American funds. It's fascinating, actually, how just a bad luck killed this one guy. And good luck helped us. It had nothing to do with the prowess of investing. It wasn't because one's Warren Buffett, one's old Josh. It wasn't like that. It's just one guy retired at the right date, just luck. Sad, man. It's sad, absolutely. American funds has another piece that I'll do. They call the Claussens versus some other group. Anyway, one guy puts all his money, and a husband and wife put all their money in treasury bonds, and one put all their money, husband and wife, in the American Income Fund of America. Pretty much the most plain vanilla fund you can have. And the difference between the two is, man, I'll do another video because that is probably the best investment sheet other than this one I'm sharing with you right now you'll ever find. It's American Funds, the Income Fund of America. I can't remember what the piece is called, but if you go to AmericanFunds.com, type in ICA. Oh man, I can't remember what it's called. The Income Fund of America, ICA. There's this chart. They do it every year. They've been doing it forever. It is the best investment chart other than this one I'm showing you right here. My man Bruce says, came in late, but would love better than 2.5 on a CD. Ain't gonna happen anytime soon, my friend. I'm telling you, not with a 10-year treasury still at 3%. Just no way. I mean, because what CDs are is the bank goes out and buys bonds. That's exactly what they do, and they're just I'm surprised they're paying 2.5 on a 1-year CD. That shocks me, frankly. I'm amazed by that. All right, so I'll throw it out there. I guess while I have you all, any thoughts, questions, comments? That's kind of what the scoop. I wanted to do a couple of things here today, was give you all the thing on the Vanguard, and I'll post a link to the show notes. This wonderful piece of literature that they write. I'll post that on there so you all can see it for yourself. And then and I just want to practice on this thing, what we're doing right here. So it's a good practice for me too. So I appreciate your patience. Any thoughts, questions, comments? Anybody else out there? Sunshine Susie out in Williamsburg, you still with us? You got anything that's on your mind? Let's see. I hate to be a teacher and have to call on people. My man Todd Seeger, I don't know, he started this chat off. So Todd says, has anyone used e-money financial product, and can you get as an independent of an investment manager? So e-money was bought out by Fidelity. So if you're part of the Fidelity group, you have access to e-money. How much they allow you to use, I just don't know. So just FYI, I'm a big fan of e-money. I think it's probably a step that much above the Right Capital software I use, just because their estate planning stuff is by far and away better. Hey, right on. Thanks, Soda Pop Curtis. But the problem with e-money is it costs like $400 a month, and for Right Capital, it's $20 a month, so it's just not worth it. I'm familiar with Bogleheads. I just, I don't know if I promote them so much. Yeah, right on. Hey, Joe, right on. There's my man Joe. So Joe says, I'll make sure I have at least 3 years in cash. I have 2 now, retiring. Yeah, I think it's spot on. And just every year, just revisit that, Joe, and see, do I have gains on the table to pull off? I'm just telling you. And that doesn't mean you have to do it, but you just have to be in charge of it. You don't want the gains to disappear because the markets took them away. And that's the most frustrating thing, is that you had a $400,000 gain, and now it's down to $100,000 because the markets took it away. And it happens all the time. Happens all the time. No one ever sits there and says, oh, I took the gains, I had to pay tax on it, and now I don't get a compounding interest on those gains. No one ever says that, but they all say the other way. I had $400,000 at the ready. I just didn't pull the trigger. Now I got $100,000. That's what people say. Bogleheads is a pretty good website. I can't remember how they started. I mean, obviously it's from Vanguard, and I forgot how they started a long time ago, but I'm a fan. They run, that's a great site. There's no other way around it. Some of those guys get really in depth and real detail. So I'm a fan of Bogleheads for sure. My only concern, guys, on Vanguard is some of the Vanguard, they get real adamant about anyone paying a fee for anything. And I don't know. At the end of the day, it's okay. I don't like investment fees. I don't think I've made light of that. But I mean, at some point, if you're trusting someone to manage your money for you, and because you simply don't want to do it yourself, and you trust that the guy or lady knows what they're doing and they have your best interests at heart, I don't have a problem with that. None. I do have a problem with investment managers who say they're financial planners and all they talk about is investment managing. I don't like that at all. And if you want to hire a guy to run your money for whatever reason, I don't care. As long as it's A, transparent how he gets paid or she, and as long as B, that they're not holding themselves to do more than they're saying they are, i.e. wealth management. What the hell is that? If all they talk about is investments, that's investment management. That's fine, but they're not financial planning. That does bother me. Hey, Sunshine Susie retiring in 2020, Joe. All right, if it's okay. So Joe says, when you say pull it off, if it's in a 401k, where do you put it? That's a good question. Ideally, you can have cash in a 401k. I mean, so like the stable bond, they have the stable value funds in there. A lot of 401ks have a stable value fund, Joe. And so what you do is, going back to the example, my 250,000 grew to 290,000 bucks. Is in a 401k. So I want to pull it out. I want to take the $40,000 gain and move it out of the equity market. Equities are synonymous with stocks. So I'm going to pull that 40,000 bucks. I'm going to do something with it, either a stable value fund or or you take it out and put it into a CD. Just be advised, if I pull that money out of my 401k and put it into a certificate of deposit, that will be a taxable distribution. Now that may or may not be okay, but you just got to understand. All I'm trying to say is, at the end of the day, we're going to pull the money off the 250 grows to 290. We're going to take $40,000. We're going to lock that sucker into our stable value fund, which is still in the context of the 401k. But at some time, that money has got to come out anyway. So you got to look at your tax consequence. But ideally, the thing would be take the $40,000 and dump into a CD so you can spend it when your other cash has you spent all that, if that makes sense. It could go to no. All right. So Joe says, okay, right on. Does it go in a Roth? No, no. We don't want any cash. We don't want any bonds in Roth whatsoever. Roth is where we put anything that's in a Roth, Joe. We want that sucker to stay in a Roth forever until we need it because we ran out of money. I mean, that's fine. Roth IRAs should never be touched, ideally, and as the last case. Now, at some point, you say, well, look, I don't want to leave it to kids. Well, that's fine. Take it out at that point. But don't touch your Roth. And the reason being because you're taking the money out and you're paying tax on it when it comes out of your 401k or IRA into the Roth, which means we want to let it to grow as tax-free as much as we possibly can to take advantage of the fact we already paid tax on that. So we don't want to touch the Roth. We don't want any bonds on the Roth, no cash, nothing like that. No. I love the 2-3-year CDs. Susie, it's so easy. 1, 2, 3-year CDs, or like my man Michael said, a T-bill. Frankly, don't care. Just CDs. We all know what CD is. Buy a CD. Matures, you spend it. Matures, you spend it. Take your money off the markets and put it back in. It's literally the easiest thing in the world. Maybe one of these days I'll do a book on that, or an ebook or something like that. Because I tell you, when I explain this to people in my career about that, you can see it. They get it. They're like, oh, that makes sense. There's nothing glamorous about that. You say, look, just keep your stock stuff diversified, total stock market, the total Vanguard index fund. American funds, I like American funds. They're a little bit more expensive than Vanguard, but they're a good fund company. I got no problem with them. Maybe use a guy, Ed Jones, and you pay him a commission and buy you something. I don't know if you need to do that anymore, but I got no problem paying commissions. It's like, again, as long as you know what you're paying for and you feel it's a value for value exchange. You're going to pay $3,500 to a guy on $100,000 investment. I mean, look, I wouldn't do it, but if you do it, I'm not going to say you're stupid or anything like that. Just as long as you know what you're getting for. But if you got an advisor who likes American funds, I got no problem with American funds. I got no problem with Vanguard. I got no problem with USAA on the bond side, and I don't have Fidelity come and go. Bogle had a big. I'll get right with you here, Sue. Bogle, I'm sure I told you all this before. Man, Bogle had this wonderful comment about the Johnson family from Fidelity when he's being interviewed by somebody, and I can't remember who it was. It was not that long ago. It was kind of like a no-name guy too. I mean, it's a good guy. I like him quite a bit. It was Jim Lang. That's who it was. A CPA, Jim Lang. Anyway, I could have sworn, I got to look at that guy, James Lang, because he has a book on Roth IRAs too, and I like his stuff a lot. And I could have sworn it was that guy. He interviewed Bogle, and Bogle, man, he did not pull punches when he's talking about Fidelity. It was awesome. So if I have my take of Bogle, let's just say Bogle's a Patriots, Fidelity's the Giants. If you know what I'm saying. I'm a Pats fan, the Giants. Roth, yes. Sue Asher, the Roth, all being absolutely. No bonds, no cash. Maybe real estate investment trusts, Sue, or REITs, maybe. If you're going to do that, I don't have a problem with that. But other than that, no bonds in Roth IRA. I'm going to tattoo it on my head up here and say no bonds in Roth IRA. Hey, Josh, what's up, Scott? When I retire at 60, should I convert some of my 401k to Roth until my 401k gets below 250 and hold off on starting Social Security? Yes. I mean, you don't have to keep it. I would convert if you can make it and convert the whole doggone thing. You don't have to, don't make 250 necessarily the threshold to convert. But no, you're hitting on the head, man. Absolutely. Start convert. In fact, pretty soon here, I'm going to introduce you all this wonderful new spreadsheet that somebody who's a near and dear friend of mine who I just met today has been working on. It is going to be awesome. It's going to be awesome. So I'm going to do this new spreadsheet and it will show you. It's going to be fan. I'm not ready to roll it out yet because I'm still testing it to see if I can't break it. And I break a lot of things, so I'm sure I'll be able to break that. Mike says short-term rates aren't currently much lower than long-term rates since the rate curve is flat. Okay, good. There you go. So Michael says Google dynamic yield curve, long-term rates and short-term rates are pretty close, which means, and this is it's funny because back in 1982, long-term rates are here, short-term rates were above long-term rates. Isn't that interesting? And now we have a flat yield curve, and typically it's like this: short-term rates will be lower, long-term rates will be higher. And then, so anyway, just real quick, it's interesting because in 1982, when everyone was so worried about inflation being like Venezuela, no one wanted to lock up their money to save their life. I'm not touching that. So I want to keep my money churning and churning so I can take advantage of ever increasing higher rates. And it turned out to be a good investment if you could have bought that 30-year Treasury bond, because it's paying 15 and a quarter guaranteed each and every year for the next 30. That sucker matured in 2011. You're getting 3.5 or 3 and a quarter in 2011. So you got 15 and a quarter for 30 years, from 1982 to 2011. 2011, you got your bond payment, that $100,000 you put in, and now you're only get 3.25 for a 30-year bond. Crazy. VTI, good for VTI is which one's that, CB? Vanguard ETF, some sort. I'm not sure exactly what it is. So type that down there. Wait, you're looking for Susie's XLS too? Too much inside stuff there. What are the REITs advantage? It's just, Michael, at the end of the day, I don't, if you're going to have anything that's dividend heavy or taxable heavy, we'd want that to be in Roth. All right. So essentially, bonds should be your IRAs, anything IRAs, CDs, anything that has ordinary income. Now, I'm looking at CDs in the context of investment, non-context of the bucket strategy we're talking here. Anything that pays a high dividend, high ordinary income. All right. And that would be CDs, bonds. REITs, they do too. REITs they're not qualified dividends, so they're ordinary dividends or regular. I can't remember. They're regular dividends anyway. But REITs does have some appreciation potential. So dividend paying stocks and REITs should be the only thing, in my opinion, that you should go in your Roth IRA, because you don't want those in a taxable account, because that could add to your taxes, that will lead to your paying more in Social Security taxes, more in your Medicare premiums, and ultimately could make a zero tax thing, i.e. long-term capital gains and qualified dividends, into a taxable thing once you hit a certain threshold of modified adjusted gross income or taxable income, depending on what we're looking at, be it Social Security or Medicare premiums or qualified dividends. And we just don't want that. So we want to have your Roth IRA as aggressive as you can with anything as dividend and income oriented with appreciation. We want your bonds and your IRA, your taxable accounts, because your bonds yield ordinary income, and anything that comes out of an IRA is also ordinary income, which is the worst kind of tax plan, income tax you can pay. And then finally, we want your taxable account. So you got the 3 accounts. We want that to be your smaller, more aggressive stuff that doesn't pay any dividend, ideally, or little to no capital gains as well, because we want that sucker to grow as much as we can in your taxable account without giving a lot of income. And for 2 reasons. One, because the income that's derived, like I just said, can add to your other taxes and whatnot. But 2, when you get hit by that proverbial bus, the taxable account that's grown from 200 to 500,000, that will transfer to your heirs completely tax-free because of the step up in basis. And what happens is, and this is what I talked about, a community property state. Let's just say me and Sue are married and we live in a community property state, and me and Sue have an account, all right, that's jointly owned, or we should say in a community property state, not jointly owned. When I die, she inherits the entirety of that property 100% tax-free, even though she effectively was half an owner of it. In a state like what I'm in here in Georgia, when my wife and I, Charlotte's my wife, when I die, she only inherits half that tax-free because of step up in basis. So at the end of the day, we want as minimal income off a taxable account with as much possible growth for those 2 reasons: to avoid taxes while we're alive and to avoid taxes when we die. It's a big, big deal, actually. And I think many, many people overlook it. And one of these days I can print out that stupid 1040. But if you just look at lines 8, 9, and 13, you'll see the amount of taxes that you are derived from your taxable accounts. And I think a lot of people would be shocked how much taxes they get and how much that costs them. And then when they hit retirement, that continues on. It's only going to make their Social Security taxes more and their Medicare premiums as well. Anyway, that would be the advantage of REITs. In terms of advantages, I don't know if there's a huge advantage necessarily in terms of growth, but for diversification, I'm very comfortable with having REITs as a part of my holdings for sure. So here's Richard. I remember you posting this on YouTube, man. We've been using the guarantee. I forgot what my GA. I know it's an annuity. as bond substitute. All right, so I forgot what MYGA. I just remember that A is annuity. But anyway, if you want to type in what that is, I don't have a problem with annuities, none whatsoever for a bond substitute. I don't. The drawback about annuities is that they're not FDIC insured. So if the insurance company goes kaput, theoretically you could lose all your money. Okay. And so I don't have any problem with using annuities as a substitute for bonds, none in the least. In fact, frankly, I think annuities get a bad rap a lot because of some of the sales tactics. But, you got these guys like Ken Fisher who just hate annuities. Ask them, he'll tell you how much he hates them. And variable annuities don't do anything for me, but fixed annuities, if I can get 5%, which for simplicity, a 5% CD or 5% fixed annuity, the 5% CD is going to pay me income as taxes, ordinary income. The 5% annuity does not. Someone's going to pay it for sure, but at least I'm deferring the taxes on it to some other day. Now that might be not advantageous to me because I might have to pull the money out at the worst possible time. I don't know, but I'm in charge of that. With a CD that's outside of an IRA, I get a 1099 every year and I have to pay tax on it. With annuity, there is no 1099. There is none. And so, again, someone's going to pay tax on the income, but you are in charge of who that person will be and when. And I think anytime you can retain authority of how you're going to pay tax is a good thing. I don't have a problem with that, other than just remembering annuity is not FDIC insured. Just remember, FDIC is a Federal Deposit Insurance Corporation, by the way. Just because the government says they're going to bank it, it's not a government bond. Like Mike was saying before, a T-bill is a government bond. It's 100% explicitly backed. There cannot be any less risky investment than a government bond. FDIC CDs are not, they have the backing of the FDIC, which is allowed to protect it by the government. And certainly if we had a big run on banks, the government would step in to some degree, but it's not as safe as I think a lot of people make it. It's certainly not, it doesn't have the same safety as a government bond. It just does not. And that's not to, disparage CDs, but they're not as safe as people think they are. Who was it? One of these banks, oh man, it took like 4 months for this lady. I can't remember what it was. Anyway, this lady, it took her 4 months to get her money back on a bank that failed. I forgot what it was, but I just remember it's like, whoa. And she needed the money, and that was not good. But she got her money back, but she needed it, and it took 4 months when the bank went kaput for the FDIC to pay her because there's a huge, I can't remember. I can't remember. But anyway, it's a big deal, and that really caused some concern. Right on, Joe. You have a good night too, man. Haven't looked at FireCalc 3.0 yet, CB. I actually, another guy was emailing me today about FireCalc. I haven't done a run through on that. So I'm looking forward to it. If that's a new software they just introduced, man, I can't wait to see it. 'Cause I'm a huge fan of FireCalc for sure. So I'll definitely give that a run. Absolutely. All right, my friends. Well, I think that's probably it for me. But yeah, be looking on the new spreadsheet for sure. We got 853. I'll do another video on the Investment Company of America thing because that's awesome. I probably won't do that live because going back and forth with the it's just not as crisp as I like. But I'll do another one, and we'll do one on the sequence of return risk. I think that's good too. Susie Michael said .gov, treasury.gov, and he says $100 as a minimum that you have to spend to buy a treasury. So $100. It's tough to see how you can go wrong with that. Now you're not making any money. You're not. You're going to pay taxes. You're going to lose inflation, but you're going to be safe. And I just tell you, safety is a valuable thing when it comes to retirement. Who needs the market to take a third of your assets, over the course of 18 months? I don't. So safety is not a bad thing. Yeah, not much. I know. I think it's freaking awesome. Overlooked a lot. All right, folks, looks like folks are signing out, so I'm going to let you all go, but I appreciate it, man. Thanks for coming up on here. And I actually, again, appreciate the clumsiness of this. I'm going to get this better, and we're going to do a lot more of these kind of things going forward. So stay tuned. Hey, have a good night, guys. Thanks, y'all.